Hello, scientific investors. Today, in the Scientific Investor series, we will talk about why scientific investors move beyond mutual funds and how. Okay, so we have been talking about this forever that first you should always start with mutual funds or ETFs or index investing. Do the SIPs there and learn the ups and downs of markets. Once you've done 5 years, most likely in 5 years, you have seen the ups and downs. Ups everyone loves, so I'm not worried about the ups. The reason you should have that experience is when it's down. So when you had a small corpus, you start with all this, maybe some stocks you have picked, some mutual funds you have picked, and it's all great. And now you have got a feel for what is equities, right? How things move up and down, that despite the down, eventually the market recovers or the stock recovers and you actually make a good return, probably significantly above the fixed deposit returns, right? And that is the whole point of having this. And so these are great things. These are lower risk things when you do ETFs, mutual funds, etc. And so the portfolio becomes well diversified, and inside the mutual fund there is diversification, right? They hold 100, 200 stocks, 50 stock, 80 stocks, and so on. And they are designed, see, ETFs are designed to deliver you index funds. Whatever is the Nifty return, you will get that, or index return, right? So Nifty 50 delivered this much, you get the same thing minus a little bit of tracking error or slightly on the fees. Mutual funds are designed so they are active funds, right? So they are designed to do slightly better than the index. Okay, but the safety is a concern. SEBI has so many constraints that even the best fund manager cannot generate too much alpha there because of the constraints that you can't own more than 10% of a company. You need to have so many companies inside a portfolio, and so on and so forth. Lot of constraints are there. Okay, so they have to follow their mandate also. So suppose something is a mid cap fund, it has to only be in mid cap for 65% of the allocation, right? Only in the 35 they have some leeway, and that some leeway doesn't mean you can do anything, right? You can have some small cap stocks, you can have some large cap stocks. So it becomes very mandate oriented. Okay, and then your personal risk appetite may not match that mandate. Somebody said it's like, look at this fund and it generated high returns, and you took it, but you didn't analyze whether it suits you, right? Whether it's your personal risk appetite, your financial goals with that, are they matching? And maybe you're looking at past track record, you're entering exactly at the wrong time when the returns are in the past. And very high past returns, sometimes they don't translate to new returns if the portfolio is not changed. If portfolio keeps changing, so I'll give you a clue, although you have to again follow us, like, subscribe, and try to find those videos. I'll try to put a video here where you can see how to look at how to select a mutual fund and to make sure that the past return is likely to continue. There is a video on that. So your outcomes depend on someone else's framework. What happens is you have no control. You just buy the mutual fund and then they will do whatever it is, and you don't know what they are doing, what philosophy they have. Little bit you will know. So this creates a mismatch between your risk profile, financial goals, and portfolio. So now that your portfolio has become meaningful, and we defined in one more video, which you can see here, about the rupee 20 lakh milestone. There is another milestone which is 1 crore. So we'll talk about further milestone as well eventually. So now that at 20 lakhs the portfolio is, the capital is meaningful, at 1 crore the capital is meaningful, and you want more control over the allocation. You want higher conviction bets. You want to have significant alpha. So there is index fund, get index, zero alpha. Then there is mutual fund which is trying to beat, and hopefully a handful of mutual funds are able to generate alpha, but it is slight. So you can say Nifty plus plus. And now you are saying, no, I have meaningful capital. I want to generate great wealth over my working lifetime, so that after retirement I have significant corpus. Retirement can be early or late, that's a different issue. But you have a target and you want high returns as well as while looking at the downside. Okay, so now this is where the whole thing shifts, and you need an active portfolio, direct equity portfolio, probably advised or managed by some professionals, so that or you can do it yourself. We are always trying to help investors to understand how to do it yourself. Whoever cannot do, of course, we are there, or people like us are there, right? And this is where you have to start exploring other approaches beyond mutual funds. Okay, So mutual funds were great training ground for you. They were great for some core allocations. And just like, FDs are also a good thing. So you had FDs, then you had mutual funds, ETFs, and now you need alternate investments like PMS or portfolio advisory services or AIFs, etc. Okay, so as you go beyond, you start thinking first as stocks and mutual funds and product led investing, and then you now start thinking of a full portfolio, asset allocation, and so on and so forth. That's the natural progression. And so hopefully now you've understood that how your journey evolves as an investor, starting from some stock picks, some mutual funds randomly selected ad hoc basis, haphazard manner, to systematic portfolio asset allocation, and then within asset allocation having the alternates, PMS, PAS like things, and creating an alternate portfolio which is high risk, high return. But again, with our scientific investing framework, we have tried to reduce that risk. That you can again see in some other video. I might not be able to put all the videos, but I'm trying to put as many as possible so that you can now diversify further. Thank you.